Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, and managing editor of ETF.com. Joining me today is ETF.com's dogged team of writers and editors, senior analyst Sumit Roy, senior content editor Ken Thune, financial reporter DJ Shaw, and contributing editor Ron Day, who will also interview our special guest, Alex Morris, CEO of FM Investments, and that'll be later in the episode. We have a lot to cover, so let's dive right in. This week, Nvidia already has had the distinction of being the world's most valuable company, but the giant chip maker crossed another threshold. It's the first public company to reach a market value of $4 trillion. DJ, you wrote about NVIDIA ETFs this week, and so tell us, what does that tremendous growth mean for investors in ETFs that emulate or hold NVDA shares? And is it too late for investors to get in on the action?
Yeah, Nvidia hitting a $4 trillion market cap is wild, and it's been a big moment, not just for the company, but for ETFs that hold it. In the piece I wrote, I looked at a few different funds that have big stakes in Nvidia, like SMH from VanEck, Columbia's SEMI, and Strive's SHOC. And what I saw is that these ETFs have been riding the wave. Some of them are up over 11 to 12% in just the past month. SMH, for example, has been over or has over 20% of its portfolio in Nvidia. So it's not surprising it saw strong gains and pulled in close to 860 million dollars in inflows. Shock, which is a bit smaller and more concentrated, also saw a solid bump in returns. And SEMI, this fund takes a broader approach. It was though it had more money flowing out over the last few months, it still showed that the strong performance. So what does all of that mean for investors? Well, if you've already been in these ETFs, you've probably had a pretty good year. But if you're looking at them now, there's always the question of if you missed the boat. And I think it depends. Nvidia has had a massive run, and it's now a huge part of a lot of tech and semiconductor ETFs. So any future gains might not come as quickly, but there's still a lot of momentum tied to long-term AI growth. And, if you believe that AI is going to keep expanding, then it might make sense for longer-term investments. So, with ETFs that hold NVIDIA, it's just kind of important to be aware of how much exposure each ETF has. Some of the funds that I mentioned are really concentrated, while others are more balanced. So it's just kind of about understanding how much of NVIDIA you actually want to be buying into.
Paul, you asked, is it too late to get in? In a sense, we've all already been in this stock for a long time. As long as you hold a broad market ETF, like an S&P 500 ETF, you've had a big position in NVIDIA since it's been one of the biggest companies in the world for some time now. I'm actually looking, it's 7.5% of the S&P 500. And interestingly, that is very similar to the weighting that NVIDIA has in the iShares Semiconductor ETF, which it has an 8% position in NVIDIA. So you're getting the same exposure to NVIDIA in something like VOO and SPY as you're getting in an ETF like SOXX, a semiconductor-focused ETF. So everyone has quite a large exposure to NVIDIA as long as you're invested in the broad U.S. stock market today.
That's a great insight, Sumit. Thank you. And it leads me to actually the next question, because it's well known that NVIDIA is also one of the so-called Magnificent Seven stocks, along with Apple, Microsoft, Alphabet, Amazon, and Meta, and Tesla. So you spotted something in a story that you wrote earlier this week that was kind of surprising. about the performance of the Roundhill Magnificent Seven ETF, also known as MAGS by ticker. And it seems almost counterintuitive to the massive popularity of these stocks. So what is it that you found and what's behind this surprising performance?
Yeah, I mean, we've been talking about the stock market hitting record highs in recent days. The S&P 500 is up something like 7% on a year-to-date basis. The NASDAQ 100 and ETFs tied to that, like the triple Qs, they're up around 9%. And the narrative has been, yeah, big tech is once again leading the market higher. But when you look under the surface, that's not exactly true. And I think the MAG 7 really illustrates this quite well. If you look at the Magnificent 7 ETF, ticker symbol MAGS, it's actually up only 2% year to date, which is quite a bit lower than the broader S&P 500. And that has to do with the fact that a lot of the MAG 7 components are actually lagging this year. We just talked about Nvidia. That's been a standout performer. It's hitting record highs. It's up significantly. Another MAG 7 component, Microsoft, is also hitting record highs and doing quite well. Both those both of those stocks, I should say, are seen as AI winners. So they've been getting a boost from the whole AI narrative. But you look at some of the other Magnificent Seven stocks, like Apple, for instance, it's down 20% from its all-time high. So still significantly below its record highs. Also, Tesla, it's percent below its all-time high. And then you got stocks kind of in the middle, like Alphabet and Amazon, which are down anywhere from about 8 to 13% from their highs. So a handful of the Mag 7 are lagging the broader market. And that's why you're seeing the underperformance in the Magnificent 7 ETF. And, you know, another ETF that I highlighted in my piece is the Defiance Large Cap X Mag 7 ETF, ticker symbol XMAG. This actually holds the 500 largest US stocks other than the Mag 7. And this ETF is up 9% year to date, which is more than the S&P 500. So that's a couple lenses through which you can see the fact that the Mag 7 as a group are underperforming this year, even though a couple of them are doing quite well, like I said, Nvidia and Microsoft. So really this group, Mag 7, is quite diverse, and they're kind of going in their own separate ways based on their own fundamentals. We know Tesla has been caught kind of in, it's faced various different headwinds. We know, Elon and Trump have kind of had a falling out. We've seen EV sales drop for Tesla quite significantly, potentially due to brand damage from Elon's association with the Trump administration. Meanwhile, you have Apple. There's this narrative that it's kind of falling behind when it comes to AI. So, a lot of different narratives for these stocks, and they're going their separate ways. So the Mag 7, we talk about it as this homogenous group. That's not necessarily the case. There's some winners and there's some losers, and you can see that reflected in this Mag 7 ETF, MAGS.
Perhaps it's time to start thinking about the demise of the Mag 7 as being the leading group. Maybe there's a new group that's going to come up with its
exactly
with
right.
its own
These acronyms kind of change over time. Remember, FANG was the popular one for a while.
Yeah. Yeah, so we went to FANG to Mag 7. Let's see what's next. I'm going to guess that it's going to be AI driven.
That's a good guess.
Yeah. All right. So now let's take a quick shift of gears. It's that time of the year when many companies and news outlets look ahead and they start to make their predictions on what to expect in the second half of the year. Mostly these prognostications tend to be positive, but Kent, as a financial planner, you take a little bit of a different perspective, and you came up with a list of things that ETF investors should be wary of over the next 6 months. Tell us what you're thinking and what you're looking at and what you're calling for.
Sure. Yeah, I look at sector ETFs as what I call satellite holdings. So I didn't make that up. A core satellite portfolio is what it sounds like. You have a core, like an S&P 500 index, and build around that, for example. And a couple of sectors I like to use, technology and health are a couple of them. But this year, some more popular sectors have been consumer discretionary, like the XLY ETF. Industrials have been hot, XLI. And of course, I mentioned technology, XLK, and there's plenty of other sector ETFs here, but I'm using these as proxies. Real estate, I use the VNQ, Vanguard's real estate ETF for a proxy there, and raw materials, XLB. Now, I'm not necessarily saying these ETFs are all going to tank and everyone should get out of them and don't even think about buying them, but really more if you're in technology, for example, which I am and a lot of my clients are. I mean, that sector is up over 40% since the post-Liberation Day tariff pause, if you will. And Nvidia is leading the pack there, up over 60% since April 8th by my measure. So yeah, it was around $100 a share. Now it's over $160 a share. But really just kind of rotating out of these. Another story I did, to give you a good example would be, okay, well, healthcare. XLV is the biggest healthcare sector there, ETF. If you're trying to, say, lock in some gains, it'd be a good time to get out of, take some winnings, if you will, out of XLK, if you're in that, or a tech sector ETF, and maybe rotate into some of the losers that are more defensive, especially if you want to hold it long term. Healthcare is a good example there. The whole premise behind these sectors not performing quite so well in the second half is really stagflation. I mean, we have, even though the Trump administration is making some deals here and there on their tariffs, we're still going to end up with the most expensive tariffs in 90 years. And so even if the impact is not as terrible as some of media outlets are saying it might be, we're still going to have some degree of inflation from that. And the economy is also slowing down. So we have a stagflationary environment coming to some degree, whether it's going to be mild, moderate, or severe. So those sectors, again, consumer discretionary, industrials, technology, real estate, and raw materials would be ones that could be impacted negatively by a stagflationary environment.
I'm also very interested in what you were mentioning about rotation, because that time of the year that a lot of people start thinking about what's going in and out of their portfolios and doing those overall assessments. So looking at the what to avoid, looking at what to add, that's the time of year for that. Moving along, we also have something very interesting. Vanguard recently made an interview with its CEO, Salim Ramji, available. And what he said had some ETF investors doing a double take. Ron, you wrote about Ramji's comments and what they may mean for those investors. I was surprised that he smacked down any kind of thought of issuing a crypto ETF, even though Vanguard is the world's second largest issuer and could easily move into that space. So what's the reasoning that he has behind that?
Well, Ramji, and it's interesting. I'll just preface it a little bit that there are several bits of ironic context to this. But I'll go to answer your question. Ramji is saying Vanguard is all about cash flow, and if you look at a list of Vanguard's top ETFs, I mean the top three hold more than $1 trillion each. Vanguard is not hurting. Right? So I guess being that large, you can kind of pick and choose. So he says we're focusing on cash flow. He said we don't have a gold ETF, we don't have a silver. Now I was talking to Bloomberg's Eric Balchunas the other day, and we were just kind of talking about the BlackRock IBIT, the big spot Bitcoin ETF, and it's pulling in so many assets and getting so much attention. It begs the question: how can you not be as big as Vanguard? How can you not have this giant client base and not launch a spot Bitcoin ETF? But Ramji said we're not going to do it, or at least I'm trying to parse the language to see if it's a non-denial denial. Kind of hard to tell, but if you look in the background a little bit, when Ramji came from BlackRock, and while at BlackRock, Ramji helped create IBIT, now the world's biggest crypto ETF. So, I don't know if it's the board of directors saying, this is our language right now, and you're going to stick by it. And Ramji is sitting there like champing at the bit, dying to put one of these things out, kind of knowing what he could do. I don't know. But as I was looking into this story, I stumbled upon another piece from 2021 where Ramji said that BlackRock, when he was at BlackRock, head of their global ETFs, said, we don't have plans to issue a crypto ETF. So, people can,
very interesting.
circumstances change.
I wonder if we could read anything into that.
Yeah. Yeah. So at the time in 2021, people were piling into these things. The SEC was grabbing all these applications.
This sounds kind of like a politician, Hey, are you thinking about running for president in 2028? We have no plans. We have no plans of running for president. Yeah. It's like he didn't say no, but necessarily,
But when you're at the top of a massive power structure like that, you parse your language. There's honesty, and then there's kind of, there's ways to talk about really not telling the truth, but you're satisfying your clientele again.
Terrific story, talking to a CEO, and that segues really well into another CEO segment. Earlier this week, you had the opportunity to sit down with Alex Morris of FM Investments. Let's have a listen to what he had to say.
This is Ron Day, ETF.com contributing editor. We have today our Thought Leader Series guest, Alex Morris, CEO of FM Investments, which manages about $8.2 billion in 16 ETFs. Alex, thanks so much for being our guest today.
Ron, thanks for having me.
Of course. So let's just jump right into the questions. It's been almost 3 years since FM launched its first ETF. Any surprises that you have encountered, and any sort of advice to share as a thought leader?
I think we've been most surprised by just how flexible the ETF wrapper is, how well known ETFs are, but how much of a disconnect there has been of what you can actually do, particularly in fixed income inside an ETF. And it's great to have conversations that folks say, I tried bond funds and ETFs, they didn't work. And then we can talk to them about the things that we've been up to, some of our competitors and cooperators in the space have been up to, and bring folks on the journey of the evolution of the fixed income ETF, which is in a far better place than it was 5 years ago and much better than it was 10 years ago.
See, 2025, it's been kind of a crazy year. Tariffs and market swooning, market coming back up. Anything that you've seen at FM Investments, or anything reflected at FM Investments in the broader markets?
Sure. Certainly, April was a dog year for all of us that I don't know if I fully recovered from yet. But this year showed that volatility can rock equity markets, that the curve can move around pretty aggressively. So it makes sense to be a few things in fixed income. One of them is liquid. You want to be able to get in and out at a fair price and know that what you paid is something today you could get out today if you needed to and changed your mind. The other is that inflation is an issue. That's part of the reason why, in addition to T-bill, which is nominal short end 90-day, we launched our bill, which is the first ultra short tips ETF to give folks protection against inflation. Although recent prints have been lower, certainly inflation risks remain high. Folks are worried about it. And ETFs yet again come to the rescue in giving folks access to an otherwise difficult to trade space in an easy to understand, completely transparent wrapper.
Yeah. Why don't you talk to us a little bit about your latest fund that you've launched, ZTOP? What is the story with ZTOP?
So ZTOP, as we call it, and yes, we did look to see if we could have ZTOP play. It was a little out of our price range, but maybe next year. Maybe after all the listeners requested, by popular request, we'll do it. But ZTOP was our answer to how can we access the high yield space. We thought all the high yield ideas had been taken based on just how big some of the high yield ETFs are. But indeed, the fact that they're so big makes it sometimes hard for them to transact, and the high yield bond space makes them a little clunky. So we came out with ZTOP. It's 100 bonds, equally weighted, focusing on the most liquid issuers in the space, which means they tend to have some really great downside protection, tend to give you most of the market on the way up. You get a positive capture ratio, which is highly unusual in the high yield bond space, which means that in the long run, you're going to get more upside than downside. And it gives folks access to this liquid thing. Let's not forget, ETFs need liquidity to work. High yield bonds, by their nature, have to lack liquidity to generally have the high yield part. That's why you want to buy it. This is a nice marriage of the two.
Yeah. Your largest fund, T-bill. Is there anything? It's $5.5 or almost $6 billion in AUM. Is there anything you'd want to talk about regarding T-bill?
Yeah, I think folks looked at T-bill as T-bill and chill when everyone was just afraid of everything and pulling out equity markets or just not wanting to invest. But mind folks that we've always held cash for some percentage of our portfolio. And T-bill is a great way to edge out of the money market space, 15 basis points in T-bill versus 30, 40, sometimes more that you see in money market funds. It is exactly what it says on the tin. This is going to be the 90-day on the run note. Sometimes we hold a couple other notes that are or a couple other the bills that are just a little bit off the run because we bought it on the run. We let them age a little bit. We don't want to make a stupid trade and cost you yield for no real apparent upside. But we come back to owning the on the run every month. And it's a great way to get access to the treasury market. It's a great way to handle your cash. It's a great way to get that nice pass-through of state and local tax exemption, but also to know exactly what you own without a whole bunch of repos, without a whole bunch of other things sitting in that you may not otherwise want to buy. Here, you know what you own, and it does exactly what it says. And we've been doing that for almost 3 years now.
Are there any areas in equity that you are intending to go for?
Most things that are thematic, I think you'll see us starting to play into. Our general philosophy is less, is there a specific asset class or target that we want to go after? More of, can we say something meaningful that we know will help investors and help advisors build better portfolios? And the markets tend to change and give us input on that. But we also find that the best product development for us is to talk to advisors, hear what troubles them, and try to build meaningful solutions that are differentiated from what's out there, but also consistent with that message that we've always had. How do we provide you what we're telling you we're providing you and just keep doing what it says on the tin?
What other fixed income areas do you think need better solutions?
Certainly, when we came out with our bill, we recognized that inflation protection is a space that needs more solutions in general and some better ones that are out there. Inflation is a generational problem. It hadn't been a problem for some time, so folks had forgotten about it, but it's coming back and it's going to be an increasingly large part of the conversation. So you'll see us do more in that space. I think also tax location is going to become a big part of the conversation. We've seen it with the 351 movement in great measure. But how can we provide you compounding price return? Because there are a lot of fixed income investors who like the yield, but don't necessarily want the distribution or the cash flow, at least not today. So our compounder series will look to break ground in that space. And beyond that, there's probably a lot of other great ideas, but our plate's pretty full with trying to achieve those two outcomes this year.
Okay, we've got about 30 seconds left. Can you briefly tell us what's next for FM? Are you moving into crypto?
So we're certainly going to do the compounder series. That's next up. We're going to hit the muni space as we have a large muni practice that we think we can develop into an ETF business as well. We've been looking at crypto. We've been looking at tokenization in particular, the short end of the curve. We haven't figured out the exact right way for us to do this consistent with the strategies that we have, but it's something we're certainly looking at. And if we find a way to do it, you guys will be the first to hear about it.
Great. We have been speaking with Alex Morris, CEO of FM Investment. Sorry about that. For our Thought Leader series.
Great interview, Ron, and thanks to Alex Morris of FM Investments for joining us this week. And thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.